Ever wondered how the stock market works? Today we unravel the mystery. Imagine a bustling marketplace, but instead of goods, it's companies that are up for grabs. That, in essence, is the stock market, a complex dynamic system where shares of publicly traded companies are bought, sold, and traded. These shares or stocks represent a piece of ownership in a company. When you buy a stock, you're buying a piece of that company, becoming a part owner. It's like buying a slice of a giant pie. The size of your slice depends on the number of shares you buy. The stock market plays a crucial role in our economy, serving as the lifeblood of capitalism. It provides companies with access to capital in exchange for a share of ownership. Understanding the stock market is the first step to becoming a successful trader. Now that we know what the stock market is, how exactly does one trade stocks? Let's dive right in. First and foremost, you'll need a broker. A broker, simply put, is a bridge between you and the stock market. They're the ones who facilitate your trades, offer you advice, and provide you with various tools and resources to help you navigate the complex world of stock trading. Now, let's talk about how a trade happens. When you decide to buy or sell a stock, you'll come across two key terms: bid price and ask price. The bid price is the highest price that a buyer is willing to pay for a stock. On the other hand, the ask price is the lowest price at which a seller is willing to sell their stock. The difference between the bid price and the ask price is known as the spread. The smaller the spread, the better it is for you as a trader, because a smaller spread means you're more likely to buy or sell at a price that's closer to the market value. Once you've decided to make a trade, you place an order. The most common type of order is a market order, which is an instruction to buy or sell a stock at the best available price. Market orders are usually executed quickly, but the price at which you buy or sell may not be the price you were expecting, especially in a volatile market. There are other types of orders too, like limit orders and stop orders, which give you more control over the price at which you buy or sell, but we'll delve into these in another episode. It's important to remember that stock trading is not a get-rich-quick scheme. It requires time, patience, and a good understanding of the market. The more you know about how the market works, the better your chances of making profitable trades. Stock trading might seem complicated, but once you grasp the basics, it's like playing a strategic game. So, get ready to strategize, take calculated risks, and potentially reap the rewards. But not all stocks are created equal, are they? Let's delve into the diverse universe of stocks where some of the most common types are, well, common stocks and preferred stocks. Your average common stock represents a slice of ownership in a company and a claim on a portion of the profits or dividends. Investors get one vote per share to elect the board members, who oversee the major decisions made by management. On the flip side, preferred stockholders generally don't have voting rights. Sounds like a bummer? Not quite. They have a higher claim on any dividends or assets if the company goes kaput. In essence, if you're after dividends, preferred stocks might be your cup of tea. But if you're looking for a say in the company's decisions and potential capital gains, you might find common stocks more appealing. Remember, each type of stock carries its own set of potential rewards and risks. Choosing the right type of stock is vital in your trading journey. Now, let's delve into the language of the stock market, the stock quotes. Imagine you're a linguist decoding a foreign language, only this time the language is that of the stock market. A stock quote is a snapshot of a particular stock's activity. It's a collection of numbers and abbreviations that, when understood, can provide a wealth of information about a company's performance, its potential for growth, and its overall financial health. At the heart of every stock quote is the ticker symbol, a unique series of letters representing a particular company. Think of it as the company's nickname on the stock market. For example, AAPL stands for Apple Inc., while GOOG represents Google. Next in line is the volume. This tells us the number of shares that have changed hands during a given period, usually a trading day. High volume often indicates a significant price movement, while low volume might suggest a less active trading day. Then we have the dividend yield, a measure of a company's annual dividend payment relative to its share price. It's a way to gauge the income you might receive in return for holding a company's stock. Higher yields can be attractive, but they may also suggest a company is facing challenges. We also have the price-to-earnings ratio, or PE ratio. This is a measure of a company's current share price relative to its per-share earnings. It gives us an idea of what the market is willing to pay for a company's earnings. A high PE ratio could suggest that a company's stock is overpriced, or it might indicate that the market expects high growth rates in the future. Lastly, there's the market capitalization, or market cap, which gives us a snapshot of a company's size. It's calculated by multiplying the company's outstanding shares by its current share price. Larger market caps often suggest more stable companies, but they may also offer less potential for rapid growth. Reading stock quotes is like reading a map, guiding you through your stock trading journey. With the map in hand, let's identify the key metrics that guide stock trading decisions. Consider this: you're on a treasure hunt and these metrics are your clues. Let's start with the price-to-earnings ratio, or PE ratio for short. It's simply the price of a share divided by its earnings per share. This ratio tells you how much investors are willing to pay per dollar of earnings. A high PE ratio could mean that a company's stock is overvalued, or that investors are expecting high growth rates in the future. Next, we have earnings per share, or EPS. This is the portion of a company's profit allocated to each outstanding share of common stock. It serves as an indicator of a company's profitability. Picture a pie. The company's profit is the pie, and each slice represents a share. The bigger the slice, the greater the company's profitability. Moving on, we encounter the dividend yield. This is a financial ratio that shows how much a company pays out in dividends each year relative to its stock price. It's like a reward for investors, a thank you note for their trust in the company. A high dividend yield can be a sign of a company's financial health and its commitment to sharing profits with investors. Finally, there's market capitalization, often called market cap. This is the total dollar market value of a company's outstanding shares of stock. Think of it as the price tag of the company in the stock market. It helps investors understand the size of a company and the potential risk or reward for owning the shares. Each of these metrics is a piece of the puzzle, a clue in our treasure hunt. They help paint a picture of a company's financial health, its performance, and its potential for future growth. These key metrics are the compass that guides your decisions in stock trading. They are your tools, your guides as you navigate the ever-changing landscape of the stock market. We've covered a lot of ground today, so let's take a moment to review. In our journey today, we first delved into the vast expanse that is the stock market. We learned that it's a vibrant marketplace where buyers and sellers meet to trade shares of publicly traded companies. Like an ocean teeming with life, the stock market is filled with activity, brimming with opportunities, but also fraught with risks that need to be navigated wisely. We then moved on to the very heart of our journey, the basics of stock trading. Here we understood that stock trading is not just about buying low and selling high. It's about understanding market trends, staying informed, making educated decisions, and sometimes just trusting your gut. Next, we explored the different types of stocks out there, from growth stocks that promise potential high returns to value stocks that are undervalued compared to their intrinsic worth. Each type of stock offers unique opportunities and challenges. Like diverse species in a forest, each stock has its own niche in the market. Our journey then took us to the art of reading stock quotes. We discovered that these numbers and symbols are not just random figures, but a language that tells a story about a company's financial health, performance, and future prospects. Like reading a book, understanding stock quotes requires patience, practice, and a keen eye for detail. Finally, we dove into the key metrics in stock trading. We learned that metrics like price-to-earnings ratio, dividend yield, and return on equity are vital tools to assess a stock's value and potential for future growth. Like a compass guiding us through the wilderness, these metrics help us navigate the complex landscape of stock trading. With these fundamentals, you're now equipped to start your journey in the exciting world of stock trading. Remember, knowledge is power. Happy trading!